You've got an impressive track record. You're a veteran of India's equity capital markets as well. So if you look back over the stretch of the last 3 decades, can you describe for us this phase of Indian equities, particularly in terms of capital, in terms of fundraising and fundraising from multinational corporations as well?
Sure, Paul. The Indian markets have, I would say, dramatically transformed after the COVID period. So we used to raise less than $10 billion annually prior to COVID. And to give you a little bit of a scale, the Indian capital markets raised about $38 billion last calendar year, a growth of 4x prior to COVID. And that put us as the 4th largest ECM market globally, just behind US, China, and Japan. And what has driven this fundamentally are 3 factors. One is clearly the strong Indian macro stability in the policy and the strong growth of the Indian corporate sector. The second has been the great degree of liquidity that's come up in the domestic market space from the mutual funds, insurance, and others. And the third factor has been the robust performance of all the corporates, right? And therefore, you see phenomenal returns of the Nifty in the last 1 year of over 20%, the mid cap and small cap over 60%. All of this coming together has really created a very robust, steady Indian equity capital market.
Yeah, well, let's look into some of those reasons in a little bit more depth. I mean, do you expect the Indian units of multinational firms to list in India, or some of those multinational firms to perhaps sell their Indian stakes going forward?
That's an interesting question, Paul, and there's a conversation we have with several of our clients. Obviously, the Indian markets are trading at very significant premium to where the global parent trades. You can, if you list in India, you can probably get a premium of 3x or 4x or 5x across several sectors. So that is very compelling. And what this does is it gives several options to the MNC parent to look at global asset allocation. Should they take some chips off the block from India and use that growth capital either to manage the balance sheet or for consolidation or for growth in other markets? So India is becoming a very strategic market for listing for several MNCs, particularly in the last, I would say, couple of years. The second factor I would say is we have seen significant sell downs by foreign promoters. For example, in the first half, it's been a phenomenal $6 billion of sell down. And this has been driven mainly by 5 to 6 large entities like Vodafone selling down in Indus Tower. And we had BAT sell down in ITC. These are 2 of the largest sell downs. So $6 billion is unusually high. And I think what the Indian market depth has created are options for MNCs to either list their Indian subsidiaries or for their listed entities to probably look at a strategic sell down, still retain control over 51%, but you get several options in a global context.
Well, the first half was very active in terms of IPOs. We saw some record amounts of block trades as well. Do you see that momentum being sustained into the second half?
Certainly, Paul, to give you a context, last year, the ECM market was roughly in India $38 billion. The first half has already seen $26 billion. And we are yet to see the largest of IPOs come to the Indian market. Many of them are targeted in the second half. The sell downs, both by the foreign promoters as well as the private equity investors, will continue to be very robust. We have already seen $26 billion of sell down in the first half as compared to 38. And I expect this to probably cross 55 billion, maybe even touch 60 billion in the current financial year. So a growth from 38 to 60 billion is a phenomenal, call it a growth rate of nearly 50%.
We've also seen a lot of participation from retail investors, particularly through flows into mutual funds as well. How much of that's been helping propel the IPO market?
Paul, that's a very interesting question, and I'll give you some statistic which will help you understand the depth of the local market. Since calendar 21, in the last 3.5 years, FIs have pumped in about $10 billion of money cumulatively in 3.5 years. During the same time, the domestic institutional investors have pumped in 10x, which is $100 billion, right? And in addition, retail investors have also invested alongside. While I may not have the exact statistic, it is far more meaningful than what the FII investors have pumped in. So what this has done is it has brought huge amount of local liquidity, supporting local growth, and therefore the volatility that you see in Indian markets are far, far lower than what you see globally. And this level of lower liquidity, lower volatility and strong returns from the market is really serving as a great platform. If India is growing at 6.5% plus on GDP, and when the flows are as strong as 50 or 60 billion, you need fresh paper. If you do not have fresh paper matching this liquidity, you'll have an asset bubble. And the good news is both last year and this year, we are seeing enough high quality paper, whether in the form of sell downs or IPOs, really balancing this and providing that much required demand supply match.
So, yeah, we've seen a big rally, as you've outlined here, but do you see any risks to this? I mean, are there risks around corporate earnings or credit growth? Has there been a dent to sentiment post-election at all, or is even the market looking perhaps a little overstretched?
Paul, there are going to be voices that will say Indian market perhaps is overstretched. I do not necessarily belong to that camp. The reason being, if you look at the large caps are trading at a 10% premium to the 10-year average in terms of valuation multiples. And therefore, India is not that expensive when you look at the kind of long-term growth. If you look at the mid cap and the small cap, yes, they're probably given much higher return. There could be some pockets of concern over there. And if corporate earnings do not match up, I probably think the market will take a breather, given the level of liquidity we have, given the amount, the quality of issuance that's in the pipeline. I think a breather is probably what you may probably expect as a risk. Indian market in the last 3.5 years has not been shut down for more than a period of, call it 1 or 2 months. And therefore, we have the tendency to correct faster and use that breather to find new supports of investing.